Well, the first trading day of the year is in the books. For how it measures up and what it indicates for the year ahead, we want to bring in Sam Stovall. He is Chief Investment Strategist at CFRA Research. And Sam, we've only got one day in the books at this point, but people say that first week of January is an indicator of what you can expect for the first month of January. That's an indicator of what you can expect for the full year. Why don't you bring us a little historical perspective on what we can take, if anything, out of yesterday's trading session?
Sure, Becky. Well, Happy New Year to you. I think what you just said indicates that investors are no better than hyperactive first graders playing musical chairs, always trying to out-anticipate the other as to what's going to happen. Right now, this is the last day of the Santa Claus rally period, and looks like we're going to be in the red. But that historically has not been such a bad indicator if it's been down. The market was still up nearly 6%. And so what it implies is maybe we'll have a weaker than a double-digit gain for all of 2025. I'm a bigger believer in January itself. As goes January, so goes the year, as popularized by the Stock Traders Almanac. And tag that with an election year, or I should say the first year of a president's term in office. And if the market was higher in that January, it was up by more than 18% on average and rose in price more than 90% of the time. So a pretty good indicator if we get off on the right foot.
In terms of your target for last year, you were looking for the S&P 500 to close a little higher than it did. What was your target, 61.45?
Yes, it was. And my expectation was that we would see a 7% price appreciation in 2025. While I still call myself a bull, I say that I'm a bull with a lowercase b, because my thought is we'd probably have high single-digit price appreciation because we're in a more challenging environment right now from a historical perspective, et cetera. And so I still feel that it'll be a good year, just not a great one.
What's the challenging part from a historical perspective?
Well, we're in the third year of a bull market, and of the 11 bull markets since World War II that celebrated their second birthday, the average gain for all of them 12 months later was less than 3%. Three of them actually fell into new bear markets, and two more posted declines on average. We've had a lot of volatility in these first-year presidential terms. 90% of these first years had declines of 5% or more, with the average being more than 17%. Also, we've only had a 1 in 5 likelihood of a third double-digit gain after an initial decline. So 2022 was down, 23, 24 up by double digits. 1 in 5 chance that this year will be double-digit as well.
Yeah, I guess another way to look at it is three-peats. You say after down years happened only 20%, like only 20% of the time since World War II. That's the period you've been watching since.
That's correct.
Okay, so
go ahead.
Well, I guess one thing we talk a lot about has been the elevated valuations. You are looking at a forward PE of 22.8 times, 22.8 times, and that's a big premium to where we've been historically as well.
It's a 20% premium over the last 10 years, and it's about a 35% premium over the last 20 years. So while it's not at the ultimate top, it's not at the pinnacle in terms of PEs, it is elevated. And so I don't think we're going to get any PE multiple expansion in 2025, but the market will be performing well, possibly, if we do get the near 13% gain in earnings. I think we're still going to need to have the Fed provide us with a little bit of a tailwind, and we're still looking for 2 cuts in 2025.